Hey, good morning, everyone. Marty Missouri here. It's Wednesday, the 5th of October, 2022, early in this session with your midweek market update. Just going to focus on the one-year daily chart and the 60-minute chart this morning. But first, I want to talk about kind of the setup as we enter into the second half of the week. So we've had a pretty incredible rally the first 2 days, up over 5% for the S&P. As I speak at you here this morning, about a third of that is being given back, a little over 1.5% down so far in the morning. Earlier in the week, what we had was a disappointing, so to speak, job openings number for August. And this is a month delay, so it'll be interesting to see what September looks like. But I think the biggest ever decline, it was over 1 million job openings disappeared in August. But we're coming off of pretty close to all-time record highs with like 11 million job openings, so we're down to 10-ish. Also, the last couple of days, global purchasing managers indexes have come out, and they've all been weaker than anticipated, and they're taking a step down. So the global economy seems to be waning, which is consistent with our analysis. There were other data points here and there, but for the most part, first part of the week showed up with weaker data. The Australian central bank night before last was fully expected to increase by 0.5%. They only increased by 0.25%, citing, potential risks. And last week we had the United Kingdom Central Bank, Bank of England, had to step in with a huge purchase of gilts, government bonds, to essentially keep their pension system, which was heavily levered to government bonds, from really blowing up with margin calls. So clearly there is growing credit market risk in the world. I've shown you that on like the MOVE index, which is the Treasury Volatility Index, the Treasury Liquidity Index, high yield spreads, credit default swap spreads. We're seeing pressure in that world. We have our own financial stress index, which is scoring like 80 right now, and 100 is as bad as it gets. So these are the kinds of concerns that historically would send the Fed rushing in the other direction, easing, printing money, lowering interest rates, certainly not raising them. And so we're beginning to see hints that this is perhaps a peak in global central bank tightening. And I want to say hints, or I want to emphasize that word, because we're still seeing, some real serious inflation out there. Now, when you look at yesterday, the logistics managers index came out, and I didn't load up any of those charts, but that's falling quite rapidly, meaning the kinds of data, inventories, warehousing, shipping costs, that sort of thing, seems to be rolling over pretty hard at the moment. So that would be bullish for equities because it would suggest that inflation's coming off the boil. But we still have, again, notwithstanding the drop in job openings, we have a pretty tight labor market. This morning, ADP, the private sector payroll company, they do a jobs report that's always 2 days before the government figure, and it was 280,000 new jobs, and it was expected to be 200,000. You saw the market kind of react to that in the pre-market. And then we had the US ISM services sector survey, right? I wrote about the manufacturing yesterday, which came in weak. Well, the services sector came in strong. And when that was reported, the S&P dropped like 0.5% instantly on that news, because that suggests that things are heating up. They're seeing inflation in the services side. We've talked about this, right? That's a rotation from purchasing goods to purchasing experiences. But it also speaks to our view that the consumer actually is in pretty good shape. So if inflation comes off the boil and the recession that we think is looming is relatively mild, you could fashion together something that says we're within a few weeks to a few months of the bottom right here. Now, in Saturday's video, I pointed to how deeply oversold the market was. It was not a feat of rocket science, let's say, to suggest that a pretty substantial rally is coming. Given all the other technical trends, we still have to say bear market rally. And so we're still in the camp that says we're going to go lower. One of the reasons I'm beginning to hedge a little bit in my commentary and say, folks, we need to start opening our minds to the possibility that maybe the worst that's yet to come isn't going to be as bad as we might have previously thought. I want to say it certainly can be. It can get even worse. There's no doubt about it. There's that risk right here. But a big part of where I'm coming from is the fact that I just am seeing all the bulls capitulate on Bloomberg this morning. HSBC, has now lowered their target for the end of the year, which happens to be our target for the bear market, still 3,500, right? And that's a come down from where they were. And it's like Wall Street firm after Wall Street firm as well is ratcheting down their expectations. And I think they're seeing, the potential for earnings really disappointing. Analysts are trying to catch up to that reality, as I've already talked about. So my point is that typically the dawn occurs amid the darkest of dark, if you will. So when I start seeing the bulls capitulate, those who have been stubborn and saying, "Oh no, we're going to come right out of this, we're going to be really good by year end," suddenly I start thinking that they may have been previously right, because once you get so bearish and you see nothing but risk around a return, a little bit of sunlight can just freak people out and suddenly they go rushing into the market. We saw that the last 2 days. Now, I want to be careful with that. I said the oversold nature was deeply oversold. I showed you some data that said a year out, like 100% of the time, when breadth is this bad and we're this oversold, stocks are actually higher. And it would not surprise me, frankly, if stocks are higher a year from now. Where we go between here and there, of course, is anybody's guess. The team who I reference here a lot the last few weeks and months, the folks who we use to get insight into underlying options positioning among dealers and so forth, they are pretty bearish right here this morning. Now, they actually were fairly bullish toward the end of last week, but what they didn't see the last couple of days is they didn't see a capitulation among the put buyers, meaning the put exposure is still there. Dealers are still having to hedge that put exposure. Days like today where the market goes down and the put buyers win, well, the put dealers have to continue to hedge, and that's shorting the underlying, so that can exacerbate the downside. I would also say, though, that if the market moves against them and these put buyers capitulate, if we had another day or something, some Fed speaker says something that encourages the market today, for example, then you're going to get an unwinding of a lot of that dealer hedging, and it could exacerbate the upside. So I appreciate where they're coming from, and what they're basically saying is that in the options pit, sentiment did not change at all. People did not rush in and buy calls the last couple of days, and therefore they can see this thing rolling right back over. And right now, so far today, that looks like it's the case. Okay, so let's look at these charts really quick, and I'll let you go. So this is the 1-year daily chart. Again, as we talked about, big bounce, right? So we do have a gap right here. Gaps tend to get filled, so we'll see if we get tested right there, right? So what I'm doing here is basically you would kind of draw this line, right? First, the top of the gap as potential support as we come back down. We may be getting close to touching that. And then the bottom of the gap right here would be the next level. So it would make sense, right, to get a retest of these levels, right? And then we'll see if this rally right here has any legs, because then you would bounce off of that and move up and test some resistance levels there. And then what you do have here, though, right, is you have just the real makings of a bear flag again. So if this were to fall apart here, this is going to be showing up on everybody's charts, and then you're going to go down here, and then you're going to be, back to threatening that 3,500 mark. We still have, at least for the moment, a buy signal on the daily from a pretty low level, and we do have the this bullish divergence here in the RSI. It's still in place on the daily chart. On the hourly chart, real short-term stuff, we have this nice gap testing right the top of that gap as we speak. We had this consolidation up in here. This does not look like a bull flag to me, by the way, but we had the MACD and the RSI rolling over. So that suggested here earlier that, and then this morning that, yeah, this could very well give way, and then we'll see how much we get back of that big 2-day rally. We had just a phenomenal setup right here, as I was pointing to. You had your falling wedge and your bullish divergences. That played out as it should have. And, right now, still kind of have that look. Not so much the wedge at this point. And, we'll update these as the hours roll on here in the next few days. But, right now, not at the moment an encouraging look on the hourly chart. It's all about if this level and this level holds and we get a big bounce off of that. As I said in the written note this morning, 7 Fed speakers are going to be out the next 3 days. Neil Kashkari is leading the pack this morning. He's been crazy hawkish. And you also have Loretta Mester. She's also very hawkish. The big question is going to be, will any of those folks who haven't yet recognize the credit market risk that's out there and the fact that some of the inflation data is beginning to roll over? If mum's the word with these last slew of speakers here, and then you get a strong jobs report on Friday, would not surprise me in the least to see all of that get given back in the last couple of days. Hints that, we got to be careful here from the Fed speakers. A weak jobs number on Friday, and you're probably going to see another big ramp up in equities. I think there's plenty of fuel to push this thing even higher. It's still within the context of a bear market rally that probably has some more downside work to go. I'll say it one more time. We're entering into the best quarter of the year off of some real weakness, off of some pretty huge oversold levels, off of pretty big cash position to mutual fund managers, portfolios, yada, yada. I could go on. The stage is set for a pretty good fourth quarter, but I wouldn't hold my breath with any of it right here. Market's dynamic, therefore our analysis must be. I'll leave it there. Thank you, folks, as always, for watching and listening, and catch you at the end of the week with another video updating the economic data and another look at the market. Bye-bye.